welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to take a hard look at the RBI's latest monetary policy announcement. Have the Monetary Policy Committee members, that is the rate-setting body, and the RBI ticked all the right boxes to spur growth in a slowing economy? Joining me in the discussion are three experts: Anand Sinha, former Deputy Governor RBI, Mritunjay Mohapatra, Chairman Syndicate Bank, and Indranil Sengupta, Chief Economist, Bank of America, Merrill Lynch. Welcome to the show, Anand, Mritunjay, Indranil. As the RBI Governor Shaktikanta Das explained in the press conference following the release of the statement, a reduction of 50 basis points would have been too much, 25 would have been inadequate to meet the situation on the ground, and so the MPC adopted a Goldilocks approach, as I'd call it, to rate setting and settled for 35 basis point reduction. Do you agree with that argument, Anand? Is 35 basis points just right to deal with an increasingly dismal macroeconomic scenario? Anand?
You see, the point is that whether it is 25 or 35 or 50, ultimately one has to take a judgment on what is considered to be appropriate at that stage. Now, there has been a convention that it is either 25 or 50 or something like that by and large. So, this is a deviation from that perspective. So, in principle, I do not find any objection to that, because after all it is a matter of calibration. The only thing I can say is that as far as the markets are concerned, earlier they would be looking at, let's say, a spectrum of 0, 25 or 50. Now they have to look at a pretty larger number than that, and it may take some time for them to adjust. But if calibration requires somewhere in between, in principle, I don't find an objection to that.
So, my question was, do you think it's sufficient to get growth, moving again?
You see, the issue is that they would have taken into account that what are the possible upside risks to inflation, and therefore, for example, one can argue, and there are many commentaries which expect the policy rate to come down to 5% by, let's say, March 2020. Now, should it be done in one go? There could be an argument that the whole thing should be done in one go, so as to give a greater stimulus to the economy. But then Monetary Policy Committee also has to be aware of the downside risks, and therefore, they have to do it in a more calibrated manner than taking a big bang approach to that. Again, it is a question of judgment.
Yes, of course, it's always a question of judgment. But Mritunjay, the RBI has forever been moaning about poor transmission, seemingly oblivious to my mind of the facts that banks in India do not rely on wholesale markets, but on retail deposits. And these are largely contracted, in fact, almost wholly contracted, I would say, on a fixed rate basis. So their ability to transmit will necessarily be limited. In such a scenario, will banks really be able to follow suit? Our former employer, State Bank of India, has already cut both deposit and lending rates. So will your bank, Syndicate Bank, for instance, follow suit? Mritunjay?
I think it's a good question. We have been debating it for last 2 or 3 policy announcements that Governor made, reducing the policy rates by 25 basis points each, and this is a valid argument, because the lag between the transmission actually happening on the ground and the borrowers getting the benefit of a policy rate cut, and the date on which the policy rates are announced has always been a matter of debate between the central banker. But in our country, as you know, MCLR is a fixed formula based kind of a phenomenon, in which the marginal borrowing rate, that is the rate at which the borrowing happens for the banks, and the banks require new deposits. Those are the things which contribute to the MCLR. Now, how quickly we can bring down these rates so that we can transmit MCLR is the question. But the fact remains that my bank, including many other banks, will be much more rapid this time, because the indications from the policymakers are quite clear.
Okay, so indications are very clear. But Indranil, the governor, also said that the RBI sees a slowdown as cyclical rather than structural. Do you agree? The reason why this is important is because cyclical slowdowns are much easier to counter and to climb out of. So should we be more sanguine, or is there a deeper concern that the slowdown might be structural? Indranil?
No, I think the slowdown is clearly cyclical. What happened is that last year you had a liquidity crunch because the RBI was selling FX and not doing OMO sufficiently at that time, and that led to this liquidity crunch, and you landed in the slowdown. A part of the slowdown is also because of base effects. If you see from December, the RBI and the government of India have been taking measure after measure after measure, whether it is cutting rates, whether it is providing liquidity, whether it is rationalizing the bankruptcy code, the PCA, providing capital to banks, one can go on and on. So we think that all these measures will take about 6 to 9 months to feed into the economy. So maybe this is the darkest before the dawn, and by the end of the year, as lending rates feed into the system, we'll see a turnaround.
I hope you're right in that, Indranil, because just today we have a piece by Ratin Roy, a very respected economist, saying that this slowdown is structural, not at all cyclical, and that is a little alarming. Anand, the governor also said that banks have parked as much as 2 lakh crores with the Reserve Bank under its reverse repo window. Should this in fact caution the RBI against further easing, mind you, because one of the reasons for the excesses that we are now paying for was the excessively loose policy of the Reserve Bank of India in the aftermath of the global financial crisis. So the problem really with monetary policy, it hits you after a lag, by which time it might often be too late. So are we in danger of doing a repeat of what we did in 2008?
You see, basically the fact that there is enough systemic liquidity, at least in the last couple of months or so, as is evident from a large amount put in the reverse repo window of RBI. So what does it indicate? That banks have money, but they are not willing to lend. And that again goes back to the crisis in the NBFC sector. So we are facing a situation where money is not an issue, and it is somewhat in a mini form. It's a market freeze, as it happened in 2008, though of course not at all close to that magnitude. So now how do you spur the banks to lend? There are 2 dimensions to that. One is of course the twin balance sheet problem still persists. Things are being done on that, but it requires a much speedier solution, which of course government is trying to do. The second thing is there has to be a much more aggressive recapitalization of the public sector banks. As far as NBFCs are concerned, the problem is that auditors and rating agencies, these two on the basis of whose judgment markets could have taken comfort, they stand somewhat discredited, and that is why people just don't know what is the status, what is the asset quality, what is the strength of various NBFCs, apart from those who are demonstrably in a very good position. So we have to somehow get out of that, and many people have been talking in terms of some kind of AQR. And I really don't see what else can be done. An AQR, of course, can result into a large number or a substantial number of NBFCs requiring resolution. But if that is required to restore market confidence, then I think that is a step that we should do. And simultaneously, we have to come out with the FRDI bill, which will be equivalent of IBC for resolution of financial institutions. So these are a number of structural kind of things which got to be done, which must be done in my view, in order to get out of this situation. Otherwise, there could be liquidity in the market, but there may not be lending. And transmission, as you discussed earlier, is always a bit of a problem in India because of structural issues. So transmission is delayed, though it should happen faster now because of large systemic liquidity, and when the cumulative effect of the rate cuts starts having a greater effect. So it will happen. But so that is something as it is. But at the same time, the basic question is how to make banks or others to lend to NBFCs, and there has to be some confidence imparted about the quality of NBFCs.
Okay, Anand, I agree with you, except that I'm a little wary when you use the word, how do you make banks lend? Because banks are in the business of lending. So if they find a profitable opportunity, you don't have to make them. They will automatically do it because that's where they get their bread and butter from, which is what brings me, Mritunjay, to my next question. The same question that I really asked Anand, that now that parking with the Reserve Bank of India has become less attractive since reverse repo rate is down to 5.15, will banks feel forced to lend, perhaps to riskier borrowers, because they have to pay interest on their deposits? Or do you think banks have learned a lesson and will not repeat the mistakes of the past? In which case, what do they do with that money? Mritunjay?
I think, as you told, this is a balancing act. Keeping money with the Reserve Bank of India, as you rightly told, is increasingly becoming less and less attractive, and any kind of small amount of margin that is available over the deposit rates is also coming down. But the fact is that the liquidity, although it is unevenly distributed across players, the aggregate liquidity that is available with the Reserve Bank through the reverse repo window may not be an indicator of the people who are willing to lend or people who are willing to support the growth before the credit incidents that we have seen in the NBFC sector in the recent past, which has kind of shaken the bankers' confidence, as Mr. Sinha rightly told, about the other validators in the form of rating agencies and auditors being the forewarners of things to come. So this shaking of the confidence which we saw in this sector has to be restored, and highly rated NBFCs are not devoid of any bank finance as of now. It is only a hoarding that is happening in the NBFC sector that is creating some amount of imbalance. But at the same time, we must also take into account that demands, except for 3 or 4 sectors, are not there in plenty for the bankers to choose and to decide. So this is a twin problem of demand as well as banking sector recovering from the NPA and the mandatory kind of provisioning that was brought in the last 2-3 years. So both these are kind of creating the problem, but system is adjusting itself, and I'm sure I think in the next 2 or 3 quarters this will come back to its normal kind of a velocity.
We all hope you're right on that, Mritunjay, but the fact is that ultimately demand is a function of how the economy is doing. And there we see, Indranil, that the RBI has reduced its GDP estimate for the current fiscal only marginally from 7% earlier to 6.9% now. But this estimate seems to be quite at variance with the rest of the commentary, because that was decidedly much more downbeat. In fact, the estimate for the first half was much more in line with the commentary. So the bank seems to pin its hopes on a very strong revival in the second half. Are you as sanguine about the second half revival, Indranil?
Just to begin, the problem is still one of tight liquidity and not easy liquidity. The money market surplus that you are seeing, listen, the money market surplus you are seeing is seasonal. After Dussehra, most of this will go away. Every year around this time, there is a huge surplus in the money market. So that's number one. Money supply growth, M3 growth is just 10%. So I would say that there is excess M3 demand of around 1.5 to 2%. And that is why, as we see the RBI do more and more of OMO, more and more of FX, we think that M3 will grow, let's say to around 12%, and that will bring down lending rates. So that's one. Secondly, we see about growth around say 6.8% for the full year. The first 2 quarters obviously are going to be weak because there are base effects, and of course because of the liquidity crunch of last year. The slowdown that you are seeing in the economy today is because of the liquidity crunch of last year. Since December, the policies have changed. So in the second half of the year, you are going to see the base effects reverse, as well as all the fruition of all these policies that the RBI and the government have taken. The Ministry of Finance has taken, and therefore I think it's only normal to assume that there will be a bounce back in the second half. Part of it again statistical, because the base effects will go away. Of course, the joker in the pack is what happens to the global situation.
Yes, of course. That is something over which we have no control. But I'm not very sure again on the issue that just because interest rates are low, corporates will borrow. Because ultimately, corporates have to see a profitable avenue. And that really is a big question mark. Are corporates being able to see that profitable avenue in an economy where there doesn't seem to be any demand and the overall sentiment is decidedly weak? But I'm afraid it's time for us to slip into a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three experts on the Reserve Bank of India's latest monetary policy statement and whether it will be enough to move the needle in an economy which doesn't seem to be going anywhere. Anand, let me now turn to the issue of NBFCs, which seems to be the biggest stumbling block at the moment. Many observers, including Ashima Goyal, former member of the RBI stack, the MPC's previous avatar, if you wish, wanted the RBI to offer a liquidity window for NBFCs on the lines of what the RBI had done earlier for mutual funds. The RBI, however, has chosen not to take this advice, so it's offered some other SOPs. How critical is this liquidity window? Have we got over the worst, or is it still that we haven't made much progress as far as resolving the NBFC crisis is concerned? Anand?
See, NBFCs, a number of steps have been taken to increase liquidity and lending from banks to the NBFCs. Even when something was done earlier for mutual funds, it was always done through the banking system. There was never a direct window. For NBFCs, same thing was done in 2008. It was again not a direct window. So, I do not think that anything much different has happened now, because to enable banks to have sufficient liquidity to lend to NBFCs has already been there. There are a number of measures. The basic issue is not liquidity again. The basic issue is willing to lend, which means the credit risk perception. And let me clarify what I said earlier when I said that banks should be made to lend. I never meant for a minute that banks should be forced to lend. What I meant was that we have to create an environment about giving confidence about the NBFC quality to enable banks to have confidence to lend, and in that context only I talked about AQR. So, I feel that the issues are deeper than simply a question of liquidity, and that needs to be tackled. And in that context I mentioned two things: some kind of asset quality review, and from a structural perspective to have the FRDI bill as soon as possible.
Anand, I was in no way implying that you meant that RBI should force the banks to lend. I was just trying to provoke you. So, with that apology, let me just move on. And Mritunjay, ask you the question that the RBI has increased the exposure that banks can take to NBFCs and has allowed them also to include lending to NBFCs for on-lending to sectors like agriculture, micro and small enterprises, affordable housing, etc. as part of the priority sector lending. Will this restore confidence in the NBFC sector? Do you see the banks lending more to them now, Mritunjay?
No, definitely these two measures, when one is talking about a percentage of the tier 1 capital of the banks being made available for individual companies lending as far as an NBFC goes, this will help. And also in agriculture, MSME as well as in housing loan, all the three sectors, the specific lending given for on lending to these sectors will be considered as priority sector banking. So, many of the banks which are falling short of their targets in these priority sectors will always be propelled to give additional funds to NBFCs who are engaged in agriculture, NBFC as well as agriculture, MSME as well as in housing. But one more thing I think some of the players in the market have told, because group wise, many of the entities are part of the group which are in all the sectors put together. So, in addition to this, I think the market, there may be one constraint where, a group exposure limit to NBFCs that may need a little bit of tweaking. That also we'll have to see. But definitely it is a positive impetus for banks to consider this as an additional incentive to start lending to NBFCs.
Indranil, the refrain all around, including from government, is that monetary policy should do all the heavy lifting. But is it realistic, in fact, to expect too much traction when only one of the two policy tools, monetary and fiscal policy, supports growth? Monetary is quite aggressive and fiscal is not. Surely received wisdom says that there is no fiscal space and government borrowing is crowding out private borrowing, etc. But is that an argument when there is no corporate demand and 10-year yields are now down more than 100 basis points this year? Indranil?
Well, we were actually in favor of a slightly higher fiscal deficit, but that didn't happen. But then, given the fact that, you are containing the fiscal deficit, you give that much more space to monetary policy. So from our side, we think that the RBI will cut to 5% by March. So 40 basis points more. We had actually expected 35 bips this time. And with bond yields coming down, if you work through the MCLR formula, you will see that there is certainly now scope for at least 50 basis point cut in lending rates. So I think that, the way we stand here from here for the next few months, all problems of transmission are now history. And you will see that, lending rates will begin to come down. And given that, the rains are good, turning around, and given that, lending rates are coming down, there should be a bounce back in the second half of the year.
Anand, the RBI now has much more powers over regulation of NBFCs and HBFCs. And though this seems to have been done in response to a demand from RBI, has it really bitten off more than it can chew? Not only because RBI does not have the wherewithal to deal with so many NBFCs, also the problem being faced today could well have been nipped in the bud had the RBI been alert to the dangers of a sharp increase in bank lending to NBFCs, Anand.
See, there is no doubt about the fact that RBI has to spruce up its own supervisory capabilities, and as you know, RBI has taken steps towards that. That is to create a specialized department, to have a specialized department along with lateral entry, so that we have a very much more professional entity in charge of supervision. So that is one step which RBI has already taken. Now, as far as NBFCs are concerned, your concern is that having got the powers, will RBI be able to exercise good supervision over the NBFCs? So the answer is, given the fact that NBFCs are roughly 10,000, slightly less than that in number, and obviously you have to have a nuanced approach to supervision. You have to focus much more on the very large ones, a little less on the middle ones, and maybe you have a reporting mechanism from the other ones, which are tiny and small. So you have to have nuance, because you can't have a staff strength which is disproportionately high if you want to have the same focus on all the NBFCs, and it is not desired also. So I think RBI has to look at its system of supervision, and as you know, they are actually doing it, and they have to have a nuanced approach on how to look at the system. The other issue which I would like to mention in the context of NBFC regulation is in the context of ILFS. Now, here you have a top, a CIC which is regulated, and underneath, apart from one NBFC, everything is a real sector entity. It is construction business. Now, how do you regulate this kind of system? Because if you regulate only the top and you have no handle on what lies in the bottom, then it is going to be disastrous in certain situations, as what has happened now. So RBI has set up a committee on looking at how to deal with the CIC regulation. I hope these aspects will also be taken into account, because the conglomerate supervision is a basic tenet of any supervision, and the idea of that supervision is not really to regulate the other entities, but to see what effect they are having on the regulated entity, and thereby to take required measures. Now, in a financial conglomerate, you have entities which RBI may not be regulating, but for which there are other regulators which have a higher standard, a good standard, and apart from that there could be coordination. Now, if you have a manufacturing unit, if you have a trading unit, then that becomes a problem, and that has been the case with ILFS, and some method will have to be devised on how to deal with such entities.
Yes, you're right, entirely right on that, Anand, which is why I fear that the RBI might just have bitten off more than it can chew. Because Mritunjay, RBI also in fact seems to have given up its fixation with external benchmarking. Do you see that as a welcome development, and would you agree that pricing is best left to banks and competition? And RBI should frankly stay out of this kind of micromanagement of telling banks how they should price their loans. Mritunjay?
I think RBI has its own, indicators to see that how we can go from completely a regulation driven pricing or a formula driven pricing to market driven pricing. This is also happening, in case of IRAC norms also. This is now a formula based kind of a provisioning. So in emerging markets, it is not uncommon to see where a prescriptive or a formula based kind of approach is provided, because the banking system is maturing. But yes, I agree with you that in a time bound manner or in a planned manner or in a given a time frame, we should go to a market based approach, which will not only transmit the policy rates much more quicker. It will also be a compulsion on the banks to perform better and perform more in a market oriented and competition driven way.
Certainly, because this smacks of the pre-reform period and those, the strictures of those days. Indranil, now let me shift to the idea of, the issue of sovereign bonds. Now that the idea of sovereign bonds seems to be on the back burner, and the governor in fact refused to be drawn into a discussion on the subject in the press conference, what kind of impact will it have on the overall macros, the yield rates, foreign portfolio flows, etc.? How will this impact all of these? Indranil?
I don't see any impact, in the sense that the FPIs who would have bought sovereign bonds would probably not have bought G-Secs. So it's not an additive inflow into funding the fiscal deficit, but a different form of inflow. So we obviously have to wait for the policymakers to decide whether they want to float sovereign bonds or not. But it is fairly yield neutral whether they do or not.
But you don't see them as risky and exposing the country to volatile flows, volatile exchange rate fluctuations, Indranil?
Well, there are arguments on both sides. When you look at sovereign bonds, given that the initial amount is going to be limited, you are exposed to fluctuations in the sovereign bond yield curve. When you are allowing FIIs into the economy, they can leave. So then your FX reserves are in question, whereas here you have a dollar funding. So it's really left, this is something the market can only wait and see which of the paths the policymakers take.
Yes, and absolutely there's a case to proceed very, very carefully and warily on that. But I'm afraid we've run out of time completely in this segment of Macros with Mythili. Thank you so much for watching. The message clearly is that the monetary policy has done a fair deal. There is still confidence to be returned to the market, but hopefully confidence will return, and with that the economy will also start looking up. Thank you so much, Anand, Mritunjay and Indranil, for joining me in the discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.